Hey, real estate investors, did you know that you can use Airbnb or VRBO property to wipe out taxes from your W-2 income without being a full-time real estate professional? Yep, it's called the short-term rental loophole, and it's one of the most powerful and legal tax strategies out there. Hey guys, I am Brett Phillips. I'm a CPA, and this is Ask a CPA, where we break down complex tax strategies into simple, actionable advice to help you save money and build wealth. Are you a real estate investor or business owner? Then hit that subscribe button as we break down hidden tax strategies that most people overlook, tips that could save you thousands of dollars in taxes. Now, today's video is coming to you straight from my own short-term rental property here in sunny Florida. Now, I love short-term rental properties, not just because this property is appreciated in value while my guests are paying down the mortgage, but because the tax benefits can be massive. And that's exactly what we're going to be diving into today, the powerful short-term rental tax loophole and how you can use it to keep more money in your pocket. So if you already own a short-term rental or are thinking about buying one, grab a pen and take some notes, because this strategy could save you thousands of dollars in taxes. Now let's break it down. Normally, rental income is considered passive under the IRS rules, and here's the catch. Passive losses like depreciation usually can't offset W-2 salary or business income. They're passive and they get suspended until you eventually sell the property, unless you qualify as a real estate professional. But short-term rental properties are a special exception. Now, the IRS doesn't treat all short-term rentals as traditional rental activity, and here's the key. So if your average guest stay is 7 days or less, or if it's 30 days or less and you provide substantial services like cleaning or meals or concierge, then your property may not be considered passive. And this comes straight from the IRS regulations, which I will link in the show notes down below. So when your short-term rental isn't passive, your rental losses like depreciation or big time losses from a cost segregation study can offset your W-2 wages or your business income or other active income. And now that's the magic of the short-term rental loophole. It can literally save investors tens of thousands of dollars taxes if done correctly. Now let's talk about the real juice, which is the depreciation. Now, when you buy a property, you get to depreciate it over 27 and a half or 39 years, but that's very slow, and that's where the cost segregation study comes into play. So a cost segregation study breaks down the property into faster depreciating assets like flooring, carpentry, appliances, and land improvements. And these can be depreciated over 5, 7, or 15 years, and bonus depreciation lets you deduct all of it right away, all up front in year one. Now, here's the best part. You don't need to wait weeks for a study or pay $5,000 plus to get this study done. Our go-to resource is 24hourscostseg.com. It's the fastest, most affordable resource out there, and it's built for residential real estate investors like you. It's a flat $500 fee, and you get a professional engineer-backed cost segregation study delivered in 24 hours. Now let's run through a quick example. So if you buy $1 million short-term rental property, the cost segregation study might carve out $250,000 that can be written off immediately. So that $250,000 loss can offset $250,000 of your W-2 or active income. Now, if you're in the top tax bracket, that's 37%, you would save $92,500 in taxes. Now, that's enough for the down payment on your next property. Seriously, before you file your taxes or make your next short-term rental purchase, visit 24hourscostseg.com and you will thank me later. To qualify for the short-term rental loophole, you have to meet two key requirements. So first, your property must meet the IRS definition of a short-term rental. That means your average guest stay is less than 7 days or 30 days if you provide substantial services like cleaning, concierge, check-in, or even meals. Now, these services transform your property from a passive rental into an active short-term rental for tax purposes. Second, you must materially participate in the activities. So the IRS gives you 3 ways to qualify. The first is the 500-hour test, where you personally spend at least 500 hours managing the property, handling bookings, communication with guests, performing maintenance, or coordinating contractors. The second is to substantially do all of the work, which now this test applies if you handle nearly every aspect of the rental property yourself without relying heavily on a property manager or contractors. And finally, there's the 100-hour test, the most time test. This is where you work at least 100 hours on the property during the year, and no one else, like a cleaner or co-host or property manager, spends more time on the property than you. Now, in order to take these huge tax deductions, you must make sure that they are executed and documented properly. Here are 5 common mistakes we see investors make that put their tax deduction at risk of being overturned if audited. Now, first, not tracking your hours properly. In order to take advantage of the short-term rental loophole, you must prove that you materially participate in the rental activity. The IRS requires detailed records for your time spent managing and operating the property. Simply saying, "I worked on it," will not cut it with the IRS. Keep a time log or a spreadsheet that documents every task and the hours that you spent working them. Include activities like coordinating cleaners, responding to guest inquiries, updating listings, performing repairs, and managing bookings. Without solid records, the IRS can easily deny your deduction. Now, number 2 is using the property personally too much. Now, there are strict limits on personal use if you want to qualify for the deduction, so the IRS is pretty clear in this. If you use your property personally for 14 days per year or 10% of the total days it's rented, whichever is greater, then you are personally using it and it will not qualify for this tax deduction. Now, personal use includes staying in the property yourself or letting friends and family stay without paying fair market rent, or even using it for maintenance trips that are primarily vacations. Number 3 is skipping the cost segregation study. So one of the biggest missed opportunities is failing to leverage a personal cost segregation study. Now, a cost segregation study breaks down the property into shorter life components, which we talked about earlier, like flooring, appliances, and landscaping, that can quickly be depreciated over a much shorter life, or even 100% upfront. Now, when this is combined with 100% bonus depreciation, this strategy can unlock massive upfront tax deductions, reducing your taxable income dramatically. So don't leave money on the table. Visit 24hourcostseg.com to maximize your tax deductions. And number 4 is allowing a manager or a cleaner to log more hours than you. So if you hire a property manager or a cleaner who spends more time on the property than you do, it can disqualify you from meeting the material participation test. So the hours that you personally work must be greater than anyone else's for that property. So just be mindful if you outsource the day-to-day management or heavy maintenance, track your hours carefully and stay actively involved. Number 5 is missing bonus depreciation deadlines. So the One Big Beautiful Bill, or OBBB, restored 100% bonus depreciation, but the timing rules matter. So you only get the 100% bonus depreciation if the property is placed in service, ready for rent on or after January 20th, 2025. If you bought your property before that date, different rules will apply and your deduction could be significantly smaller. So proper planning around the acquisition and service dates is essential to maximizing tax deductions. Now, real estate is one of the most powerful wealth building tools, but only if you play the tax game smart. If you already own a short-term rental property or are thinking about buying a property, take the time to structure the deal correctly. Use the proper loopholes and tax deductions to maximize your tax savings. Track your time and let bonus depreciation do the heavy lifting. If you need help, talk to your CPA or reach out to us at Shiflett & Phillips LLP. I'll leave our contact information down below. And for fast, accurate cost segregation studies, go over to 24hourcostseg.com. Don't overpay and don't wait weeks for a study when you can simply do it through 24hourcostseg.com. If you want more tax strategies like this, subscribe to Ask a CPA or drop us a question or a comment down below, and we'll make sure to reply quickly. This has been Ask a CPA. My name is Brett Phillips. Thanks so much for watching, guys, and we will see you on the next one. Take care.